welcome everybody to this webinar on tax planning for retail and sophisticated investors. We have with us Umair Minhas, who's a director in the private clients family office team at PwC and has spent over 14 years of experience servicing Australia's prominent figures and families. Umair's experience in the private client space means he has a wide knowledge of Australian tax to manage risk and identify future opportunities, together with other immediate needs of wealthy families, including historical analysis and reporting, future trends, forecasting, structuring, asset protection, family education, and estate planning. Umair has a particular focus on advising ultra-high net worth individuals, C-suite executives, and professionals with expertise in tax advisory, compliance, family trusts, private companies, superannuation, forecasts and modeling, and retirement planning. We are very lucky to have him come to this webinar and give us his insights and expertise. I'm sure you'll find invaluable wisdom in this content. Firstly, thank you so much for giving your time, Umair, and welcome to our webinar.
No worries. Thanks, Prashant. Hi, guys. Good afternoon, everyone. So like Prashant mentioned, my name is Umair. I work in the private clients team in PwC. I've been here for almost 15 years and look after a lot of passive type clients. So a lot of my clients actually have Sharesight portfolios as well. So it's a really good segue into having a session with you guys just to see how I can guide you with some comments around year-end planning. Before we get stuck in, I would just like to touch base and acknowledge all of the recent media surrounding PwC and the broader issue that's happening. While there's certainly no excuse to justify what happened, I would just like to highlight a couple of key thoughts on that I think would put your mind at ease as well, somewhat. The incident did happen over 8 years ago, so it is something that's happened a while now, and it's been happening in the media for a couple of months now. Myself or anyone that I work with directly, including the partners in our team, none of us in the private client tax team were actually involved with what's happened. So you can rest assured, any comments here or anything we talk about won't certainly be shared. The key partners, so there were 4 partners. Their names were announced in the media a couple of days ago. They mostly sat within the international tax and the tax controversy teams. So their names have been flagged as I mentioned, and rest assured those guys are no longer with the firm. They've actually left the partnership a few years ago. And then just one last thing, the investigation is ongoing, as you would have seen in the media. We're getting articles and updates from our CEOs fairly regularly. We are actually taking it very, very seriously. It is not a laughing matter at all. And our internal measures around confidentiality and integrity are continuously being reviewed and improved. So I just wanted to raise that. I'm sure some of you may be concerned about what's been happening with the firm, so I just wanted to let you know and give you an update. And we'll get stuck into the session now. Just a bit of context on what I think we will be doing. We do have some slides, so I'll cover the slides and I'll go through the content in there. The content in the slides is very high level because we could talk about this, for all day, but I will give some flavor around some strategies on the bullet points that we cover. And then I have seen a whole bunch of questions that have been submitted prior to the session. So the idea is to go through those questions, but unfortunately we just don't have time to cover all of the 50 odd questions that have been submitted. So I will give you, there's very general themes in those questions around crypto and entities, trusts, companies, super funds, and capital gains tax. So I will pick the ones with some common themes and go through those as an example, and then if we have some time, I'm happy to answer any live questions we have. So with that in mind, I will just share my screen and go through the content. And if you have any questions as I go along, please feel free to put them in the Q&A session. I will touch back on that after every kind of major section to see if there's anything we can answer immediately that might help. So just bear in mind while I share the screen, and then we will get it up and running. So I think that's how it works. So can everyone see that? Prashant, you can see that? Great. Okay, I'll put it on full screen and we'll get stuck in. Okay, so year-end planning, there's actually quite a lot to think about when it comes to planning prior to 30 June. So I'm sure most of the people on the call know we're in Australia, we go by a financial year which ends at 30 June. So any transactions or any strategies that need to be put in place ideally must happen prior to 30 June in order for the impact to be recorded in the FY23 financial year, so your 2023 tax year. What I'll do is I'll cover individuals, followed by super, followed by trusts and companies. And that way we can chat about each kind of entity on its own right. And if you have any questions, I'll jump out of the full screen after covering that entity to see if there's anything we want to talk about now. Otherwise, we can jump back into the Q&A at the end of the session. So just starting with individuals, with the federal budget that happened last month in early May, thankfully, there wasn't too much change that occurred throughout the federal budget with respect to passive entities and individuals. The super changes, there are some on the horizon, which I'll touch base later in the session. But with respect to individuals, there was no substantial changes. Thankfully, and the good news is that the Labor government haven't made any changes to the stage 3 tax cuts that are proposed to come into play in FY25. So they seem to be sticking to their election promises there, and the plan is to bring that into effect 1 July 2024. So what that means for individuals is that the current marginal tax thresholds where you start to pay 47% tax applies from 180,000. That's proposed to go to 200,000. So you'll get an uplift in your marginal rate threshold there. But more importantly, you actually do get a flat rate of 30% applied up to $200,000 as opposed to the current marginal rate, which is about 39%. So there will be tax saved on the basis these stage 3 tax cuts come into play. We did some rough modelling a few years ago when these were first being talked about, and on someone earning about $200,000 of income, there's about $8,000 to $9,000 of tax saved annually. So that's a fair bit of tax that will be coming back, and the back pockets will be that little bit better. But that's not in place yet, and it's not law yet either. So we just need to be mindful that it's proposed and it's likely to come in rather than actually being put into legislation just yet. Superannuation guarantee, so that's being increased to 11%. It's currently 10.9%, so that's coming into effect from next month. So that's an FY24 adjustment. So just be mindful that for those guys on the webinar that are getting salary and wages, that extra 0.5% will now go into your superannuation fund. And some employment agreements, if they're on a package remuneration, that could mean that your personal wage salary that you get paid into your bank account might be that little bit lower. But I tend to typically find that most employers tend to just increase their superannuation guarantee without impacting the base wage. So it's just something to be mindful of. For those individuals in the webinar that pay themselves a wage from their related entities. So you may be a director of a company or a trustee company and you pay yourself a wage. You just need to be mindful that from a legal perspective, the superannuation guarantee payments that you need to pay yourself from next month will increase by about 0.5%. So it'll be 11%, not 10.5%, which is currently the case. Other than that, there weren't too many changes in the federal budget when it comes to individuals. There were changes to instant asset write-offs and a few other things around businesses, but nothing to mention regarding individuals. So with respect to planning for year end when it comes to individuals, typically the discussion involves around understanding what your taxable income will be for that financial year. And if you do have passive assets, or if you do have discretion whereby you have the ability to potentially defer income by raising invoices in July as opposed to raising them now, or you have discretion around paying dividends or receiving income, you may want to think about potentially deferring that income into July, because that would then result in that income being subject to tax in the FY24 financial year as opposed to the FY23 financial year. And that can give you a timing benefit, obviously, from when the tax is due on that. So deferring income may be something you might want to think about. Expenses and deductions are the other ones. So if we can bring our income lower but then increase our expenses, that typically tends to help with tax. So if you've got rental properties, you might want to think about paying for some repairs and maintenance, or bringing forward some expenses around buying equipment, or improving your home office or things like that. So expenses then result in high deductions. You do want to be careful that what you're spending on does have a nexus or some sort of a relationship with you deriving income. So buying a fancy car, you probably can't claim a tax deduction for it. So just be mindful of the nexus between what you're spending the money on. You do need to have that relationship between that expense being used to derive assessable income. Now, spending money for the sake of spending money doesn't always help with tax. While it will help tax, you're still spending money at the end of the day, and you're never going to get a tax benefit for the entire expense that you've incurred. So take donations for an example. If you donate $1,000 to a charity that is a deductible gift recipient, while you're doing a great thing and going towards a good cause, the tax benefit of that donation expense is at your marginal rate. So if you're earning $180,000 or more, you get 47 cents in the dollar back on that donation or that expense. You're never actually going to get the full dollar back. So you just have to be mindful that while expenses help, you only get a certain element back, and it's not the full expense that you're getting the tax benefit of, if that makes sense. Prepayment of interest. So that's something we tend to see with our clients. In the past, with interest rates being so low, it hasn't been much of a planning exercise, but now there is a genuine discussion that we're having with clients, because prepaying interest now may result in a material interest saving as opposed to later down the track if interest rates continue to rise. So you might want to have a think about prepaying interest on investment loans or rental properties and things like that. That will then bring forward the tax deduction in FY23, but it also might help from a commercial and an interest rate perspective if you can bring forward an interest deduction now at current rates as opposed to potentially a higher interest rate in the future. So just be mindful that my experience with having clients prepay interest, it does tend to take a couple of weeks by the time you speak to bankers and arrange all the paperwork and get it put in place. So if you do want to have a discussion with your banker about prepaying some interest, you might want to have that very soon, because it does take a couple of weeks for it all to kind of flow through and you being able to prepay that interest. So don't leave it till the 26th of June, because it's unlikely that the bank will come on board. So you might want to have a think about doing it now if that's something you want to think about. CGT planning and thinking about your investments if they're held in individual names. So the guys on the call, being through Sharesight, it's likely that you do have some platforms and some software through Sharesight that can help you understand what your capital positions are within investments. If they're held in individual names, then on the basis they're held on capital account, then they're subject to tax at individual name, individual tax rates. But if you hold the asset for more than 12 months, the capital gain is subject to the 50% capital gains tax discount. So if you do have some gains that have already been crystallized, you might just want to have a think about your other investments and whether there are some unrealized losses that potentially could be crystallized this side of 30 June. That would then mean that any gains that have already been derived would be offset by those losses, and the net gain would then be subject to tax. So Sharesight is really useful in that respect because it gives you real-time data, and you can run unrealized capital gains reports to see what your loss or gain position is on your investments. You can then use that data to have a bit of a planning exercise on whether there's anything you wish to sell to try and offset other capital gains. Just be mindful that whilst crystallizing losses is helpful from a tax perspective, tax shouldn't be the main primary focus on driving investment decisions. So if anything is under the water, if you feel like it's still a good investment, and if you feel like it will come back and it'll appreciate over time, you might just want to think about holding on to it from an investment perspective rather than selling it. So just make sure you get your own investment advice if you are looking to sell something. I'm not sure if you guys know what wash sales are, but you need to be very careful with selling investments just for the sake of crystallizing losses. So a wash sale is when you have Commonwealth Bank, for example, that's in a capital loss position. So you decide to sell Commonwealth Bank shares today, and then a few days later you go out and buy more Commonwealth Bank shares at their current cost base, and the transaction is simply being derived just to crystallize capital loss. That's called a wash sale. So the ATO, if they do were to look at it, will deny you that loss because they will say that you've done that transaction simply to crystallize that capital loss for tax purposes. So just be mindful of these wash sale rules. They can deny you that loss if it is a wash sale. Donations, obviously, family giving. That's a key aspect of our clients, and it might be the case for you guys as well. Donations, if they're to a deductible gift recipient or a private ancillary fund, they are tax deductible. So if you make that donation pre-30 June, you will get that tax deduction in FY23. Just be mindful that the entity you're donating to must be a deductible gift recipient. If it isn't, then your deduction may not be allowed. So be mindful of that, guys. Super, I'll come back to in a second, but if I'll just pause there to see if anybody has any questions now, and we can look at that before we move forward. The audio quality is very poor. Okay, I might just zoom in a bit and see if speaking closer to the laptop helps. Okay, well, it looks like there's no questions at the moment, so I will move on to, oh, there we go, Pete. Pete asked the question, does the wash sale caution apply to selling from personal portfolio and purchasing in super fund? Look, it can, because it is a related entity, so you just need to be mindful of that. But if you have a commercial reason why you're doing that, then you're probably okay. So um, just be mindful. Speak to someone before you decide to sell in personal and buy the same asset in a related entity. Okay, moving on to super. So super, from an individual perspective, can be a very useful way of managing tax. Look, before we get stuck into the tax implications, it is mindful for everyone on the call just to be aware that if you are considering putting money into super, you should seek your own financial advice before doing so, because if you're in your 30s or your 40s and you put some money in, then it's highly unlikely that you'll be able to look at that prior to you retiring, which could be 30, 35 years away. So I can chat through the tax implications of you putting money into super, but if you are putting money in, you might want to seek your own financial advice before doing so. Now, with super, there's really two buckets of super contributions. There's the pre-tax money, which is called concessional contributions, and then there's the after-tax funds, which are called non-concessional contributions. So every individual has their own cap when it comes to concessional and non-concessional contributions. The current concessional contribution cap is 27,500. So that was increased a couple of years ago from 25,000. And concessional contributions include compulsory superannuation guarantee payments that are made on wages by employers. So, for example, I get paid from PwC. PwC would make compulsory 10.5% superannuation guarantee payments on my behalf to my super fund. That's considered a concessional contribution. If you decide to salary sacrifice part of your wage and put that into super, that's also a concessional contribution. And then finally, any amounts that you put into super that you then claim a tax deduction in your individual name, they are also considered concessional contributions. So typically speaking, what we would have a discussion with our clients with respect to concessional contributions is if you've got an individual who is working and is receiving a wage, then typically we have a look at how much superannuation guarantee payments have been made on their behalf by their employer. And if there is room to top them up, then they can have a decision around whether they want to make a personal contribution and claim a tax deduction for it. So, to give you an example, someone who's earning, let's say, $200,000 of base wages, they would have about $20,000 of superannuation guarantee payments made on their behalf. So they've got this $7,500 buffer, and if they wish to use that buffer, they could put $7,500 into super as a personal contribution and then claim a tax deduction for it. So that would help from a tax perspective because your taxable income comes down and more money goes into super as a concessional contribution. So concessional contributions are subject to tax at 15% in super. So when your employer puts the money in, that's taxed at 15%. If you make a personal concessional contribution, that's also subject to tax at 15%, but then you claim a tax deduction at your marginal tax rate. So there can be a tax saving on a net perspective if you were to make a top up, but you have to look at your own taxable income to see what that tax saving is. If someone's earning $180,000 or more, and their tax rate is 47%, then your net tax saving can be 32%, which is the 47 less than 15%. There is another strategy with respect to unused concessional contributions. So a couple of years ago, the government made this change whereby individuals who have a total superannuation balance of less than $500,000 are allowed to tap into unused concessional contributions from prior years. So what that means is if you've got these buffers for the last couple of years and you've got a bit of spare cash that you want to put into super, you could work out how much unused cap you've got in each year, and I think you can go back up to 5 years and use those and make a big concessional contribution top up, for which you can then claim a tax deduction. So I'll give you an example. If a non-working spouse has not made a personal contribution in FY22, then they could put in the concessional cap for that year, plus this year's cap as a concessional contribution and claim a big tax deduction. So that could be, around $55,000 that they can put into super to claim a tax deduction to offset against other income they derive. So unused concessional contributions are a really good thing to look into. You just want to make sure your balance is under $500,000 for you to be eligible. And you also need to have a think about whether you've got enough income to be able to offset that deduction in your personal name. Typically speaking, you want to have a reasonable amount of income in your personal name, because when the money goes into super, it is subject to tax at 15%. So you want to make sure that the deduction you're getting is subject to your own marginal rates, so that you are putting the money in on a net perspective. One other thing to be mindful of with concessional contributions, and like I said, this does include superannuation guarantee payments. If your adjusted income in a financial year exceeds 250,000, then the money that goes into super is subject to an additional 15% tax, and that's known as Division 293 tax. So overall, the money in super will be taxed at 30% if your income is over 250,000. And this 250,000 number is not taxable income. It's very important to be aware of that. It's what they call adjusted taxable income. So the money, the amount that you actually claim a tax deduction for is added back to get this $250,000 number. And there's a few other very key items which are also added back around working out what your $250,000 number is. And one of the key items is also rental losses. So if your taxable income is 250, but you've claimed, let's say, a $20,000 super deduction, and you've got $20,000 in rental losses, then your adjusted income is actually over 250. So you just need to be mindful that if you're close to this number, that you have to do these adjustments to actually work out what your taxable income is for Division 293 purposes. And if you do creep over, then you're subject that the concessional contributions that you make in that year, they're subject to an additional 15% tax. So it'll be a total 30% tax rate. So if you are in this position and your income exceeds 250,000, if you put the money into super, your tax deduction is at 47%, whereas the tax in super is at 30%. So that marginal rate difference reduces from 32% to that lower number, which is 17%. So important to be aware that the benefit of the tax deduction becomes lower if you're over 250. So that's concessional contributions in a nutshell. Non-concessional contributions are funded from what they call after-tax money. So, for example, if that individual who's earning $200,000, the employer has withheld PwC tax from your wages, and it's been paid into your bank account, and over a couple of months you've now got a healthy savings account and you're trying to determine what you want to do with it. If you speak to a financial advisor and decide to make a non-concessional contribution, then you could take those savings and move them into super. Now, non-concessional contributions are not subject to tax in super when you do put the money in, so there's no 15% tax that's taxed in super, and at the same time you don't claim a tax deduction for that amount either. So there's no tax impact with you moving non-concessional money around. Now, clients always ask me, okay, well, if there's no tax impact, why would you want to do it, right? So The reason, and this is more of an investment decision rather than a tax decision, so make sure you get your own investment advice. But the reason is for long-term capital appreciation. So if you have some money set aside and you invest that in your own name, the investment income that you derive from that pot of money, that could be subject to tax of up to 47%. So let's say if you've got $100,000 set aside and you decide to buy Commonwealth Bank shares in your own name, the dividends from those shares are subject to your individual marginal tax rates, less the franking credits. Whereas if you put that money into super as a non-concessional contribution, then the same dividend is subject to 15% tax in super, and you still get the benefit of the franking credit, which basically means that the net tax effect of having that same investment income is much, much lower in super as opposed to your individual capacity. So that's why you want to have a think about potentially moving some more money into super as a non-concessional contribution. If you've got a fair bit of money set aside, you're allowed to use this 3-year bring forward position and actually put in 3 years worth of your non-concessional contribution cap. So you're allowed to put in $330,000 in one lump sum. If you do that, just be mindful that your non-concessional contribution caps for the next 2 years are also being utilized at the same time. So just to kind of feed that through as an example, if you do make the $330,000 contribution in June 2023, then that contribution is being used towards your FY23 cap, your FY24 cap, and your FY25 cap. So if you put it in now, you're maxed out for the next 3 financial years. So just be mindful that you're unable to make future non-concessional contributions for those 2 years if you do decide to put in that $330,000. The government did make some changes, and they relaxed the rules around meeting the work test in order to make non-concessional contributions. So before, you needed to meet the work test at a certain age in order to put money into super through non-concessional. That's now no longer required if you're under 75 years old. And the work test, broadly speaking, requires you to be gainfully employed for about 40 hours in a period. And if you are gainfully employed, then you meet this work test and you're allowed to put money in. So that's good, because you don't need to meet the work test if you're under 75. And just another update regarding super, the transfer balance cap limit, which when these rules were first introduced in 2017, that limit was 1.6 million. So if you had a balance already of 1.6 million, you couldn't actually put any more non-concessional contributions in. That is currently 1.7 million, and it's due to increase to 1.9 million from FY24. So it's more around indexing just to keep these caps in line with what's happening with the broader economy, especially with inflation where it is. They acknowledge that the CPI and the inflation impact on these caps does mean that the real money that's been going in isn't the same as what it used to be 5 years ago. So they bump it up accordingly to try and equalize it. So I'll just pause there when it comes to concessionals and non-concessional contributions. I do have some comments which I'll get to around pensions and withdrawals out of super, but were there any questions with respect to putting money into super?
I think I see one, Umair. It says from Donald, do I need to have worked in the financial year to make a personal concessional contribution to super in that financial year if I'm under 67?
Do I need to work in the financial year? Look, you don't need to work. You can put a concessional contribution, but in order to treat it as a concessional contribution, you need to be able to claim a tax deduction for it. So if you don't have any income to offset the deduction against, then that might be a problem because they may treat that amount as a non-concessional contribution if you're unable to claim a tax deduction for the amount. So you don't need to be working, but you need to have income in your name to be able to offset that deduction and be able to treat it as a concessional contribution. If you don't have the income, then you'll be denied that deduction because you can't create a tax loss from personal superannuation contributions. So they, rather than your income being negative, it will just be denied as a deduction, which means if you put that money in and you haven't claimed a tax deduction for it, then it's actually a non-concessional contribution. And that might then impact your other circumstances because you may have already put non-concessional contributions in and you might reach your cap. So whilst you don't need to be working, you do need to have income in order to be able to offset that deduction. How do spouse contributions work? Whose 27,000 is affected, the spouse or the giver of the spouse? So if your spouse makes a superannuation contribution, then it's your spouse's cap that's being used. So you could give your spouse some money as a family entity, and that money can then be used to fund your spouse's contribution, and that would be your spouse's cap, which will be used, not yours. Can you explain against the cap of 1.7 and 1.9? So, Jennifer, back in June 2017, these new rules were put in place where in the old days, there were no upper limit on pension balances, and essentially a whole bunch of money for that was in super was being put into pension accounts. And if you're in pension accounts, that the income derived in those pension accounts isn't subject to tax. So the government weren't too happy with that. They said, okay, we'll let you have pensions because that's the whole concept of super, to help you fund your retirement. But rather than having $2 or $3 or $5 million superannuation balances, which are all in pension, we're going to cap that to 1.6 million. So essentially, if you're one of the few lucky individuals who has a lot of money in super, essentially what that meant was you had to split your super balances between what is a pension balance or a pension account and what is continued to keep as an accumulation account. So essentially that 1.6 million was your cap for pensions. And for individuals who didn't have 1.6 million in super, the government basically came to this number trying to work backwards to try and understand how much income would be derived on this 1.6 million and how much a typical Australian individual would need to retire on. So they basically worked out this 1.6 million, and because of this cap, individuals who didn't have up to 1.6 million already in super weren't able to make further non-concessional contributions into super. So take me, for example, I'm not anywhere near 1.6 million. If I do exceed the 1.6 million, I can't put any non-concessional contributions into super. But if I'm still being employed by PwC, I could still receive compulsory superannuation guaranteed payments, even if I'm over 1.6 million. So there's a few dynamics when it comes to what the cap actually means. But the good thing is that it is going up, so that will help trying to get more money into super. But you do need to get some individual tax advice because it does impact each individual quite differently. So I hope that helped, but I think you might want to just have a speak to your accountant. Donald, can I use a deduction to offset tax on a capital gain? If you're talking about your super deduction, then yes, you can. So capital gain is taxable income. So let's just work through an example. Let's say you make a $100,000 capital gain on an investment sale. If that investment was held for more than 12 months, then that 100,000 capital gain is subject to the 50% capital gains tax discount. So that 100 becomes 50, And then if you use part of the proceeds to put money into super as a concessional contribution, so let's say you put in $27,000, you can then claim a tax deduction for that 27. So your income in your tax return will show a net taxable income of 50 less the 27. So that'll be that reduced taxable income on which you'll be subject to tax on. So hope that helps. Clarify that. Bob puts $10,000 into Betty Super. Bob's 27,000 is reduced Betty. Not sure what you mean by that. But if Bob is giving $10,000 to Betty, then Betty can use that to make her own contribution. There are some rules around making spouse concession contributions, but if I'm honest, I don't tend to look at those in a great amount of detail because typically speaking, it's the individual who funds the contribution themselves. But happy to take that offline if you like. Okay, just conscious of time. I think we will move on because I don't think we'll get enough time to talk through those questions given we only have 20 minutes left. So the next slide is around taking money out of super rather than putting money into super. If you do have pension balances, then you need to make sure that the minimum pension requirements for FY23 are met prior to 30 June 2023. Back when COVID first came into place, there was a lot of uncertainty around capital appreciation and depreciation on investments, as well as the ability for a lot of these companies and investments to actually pay a continued amount of investment income. So the government brought in these COVID 50% reduction rules, whereby the minimum pension that was required to be withdrawn was essentially halved. And now that is continuing on up till 30 June 2023, and then that's going away from FY24 going forward. So essentially, if you're in a pension and you've got a pension balance, you're required to take a certain percentage out every year. That percentage at the moment is half. So typically speaking, that percentage is 4%. It starts at 4% and then it creeps up based on your age. That 4% is currently half to 2%. So you just want to be mindful that you've taken out your minimum pension prior to 30 June 2023. Otherwise, you do have a risk of that pension account reverting back to an accumulation account. So make sure you take your pensions out. Like I said, the pension balance, the super transfer balance cap is increasing to 1.9 million from next financial year. So that can provide an opportunity for individuals to put more money into super if they haven't done so. Make sure you don't go over your caps. That's very important because if you do exceed your caps, then depending on your circumstances and what you've actually breached, you can figure some undue tax consequences. So you just want to be mindful that where you can, you don't exceed your annual concessional and non-concessional caps. If you do, there are some strategies that can be used to help mitigate any tax impact, but they're on a case-by-case basis. You just want to make sure you don't try to exceed your caps. And then lastly, you would have seen a couple of months ago, the government announced these changes to super, whereby individuals who've got balances of more than $3 million, the earnings on those funds in excess of the 3 million will now be subject to an extra 15% tax. So a couple of things just to note on that. Again, it's a proposal. It's not law just yet. So they're working through that. But in the budget, they did kind of reinforce that this is likely to go through the way it is. It will be applying from 1 July 2025. So that's FY26. So we do have 2 years until it kicks in. And the more important thing is if you are firstly fortunate enough to have $3 million in super, you just want to be absolutely sure that these extra 15% tax is applicable to unrealized gains. So if your investment portfolio goes up by 10%, even though that's a non-cash return because you've made money but you haven't got that in your bank account, it's the value of those investments. Under these proposed changes, that unrealized gain will also be subject to tax. So you can see how some clients are concerned because they're essentially taxing um, profits that haven't been paid and funding the tax on that on those unrealized gains will become a challenge. So I'm certainly having quite a lot of discussions with my clients around planning, even though we're 2 years away. Some clients are actively thinking about what this means for their superannuation balances. So they're quite nervous about understanding what the unrealized gains tax impact is because super funds can have wild fluctuations with their balances and asset valuations, and trying to pay tax on unrealized gains could be quite challenging. So this is something everyone just needs to be aware of. The $3 million cap does not appear to be indexed either. So it'll be $3 million in 2026. Based on what I've read and what the commentary has been under the proposed changes, that $3 million will remain at $3 million for 5 years, for 10 years, for 20 years, etc., etc. So there's no comments or talks about indexing that $3 million cap like they're doing with this transfer balance cap. So that's a little bit scary because if you're like me and you wish to put some money into super, then in 20 or 30 years' time, if that $3 million number is that's still $3 million because they haven't indexed it, then people would be a little bit turned off by putting more money into super. So just something for you guys to be aware of. I'm certainly keeping an eye out for it, and I will be eagerly reading the legislation when it does pass as law so that I can have genuine discussions with my clients about what to do with this new rule. Moving on from super, let's talk about trusts. So trusts have had a lot of activity with respect to the ATO over the last 18 months. And I don't have time to go through it today, so I've put it onto the screen. They've released updated guidance, taxation ruling 2022/4, and practical compliance guidelines 2022/2. If you've got a trust and you distribute to individuals and companies, highly recommend that you have a read of it because it can impact your future distribution strategies and your tax positions. Again, they've revised and reissued guidance on Section 100A, which is a provision of the Tax Act. Now, important to know that this tax is not a new tax. This has been in the legislation for decades. It's just that the ATO is now refocusing on it and have they've changed their interpretation so that it allows more of a streamlined distribution of income based on what they view this legislation to be. So please make sure you speak to your accountant or your tax advisor about these rulings. There's very, very specific guidance and examples set out in these rulings that will give you the flavor around what they're looking to do. They are looking to change the behavior of clients, individuals that have trusts, and they have provided what they call green zones and red zones, whereby if you do something that they don't like and it's within this red zone, they have said that they will dedicate compliance resources and potentially have a chat to you about what you've been up to. And if they don't like it, they might reverse it or cancel it or raise amended assessments under what they call the 100A provision. So trusts have had a lot of action over the last 18 months. Please be mindful of that. Now, with year-end planning and year-end documentation, Very, very important that you consider the income of your trust, whether it's investment or active, whatever it might be, and consider what the trustee does from an income distribution perspective. Typically speaking, and this is the case for 99% of trusts, uh, a distribution needs to be made by 30 June each year in order to distribute the income. If the income isn't distributed, you do have to look at your deed to see what happens if a resolution is not made. But in a lot of circumstances, if the trustee is assessed on that income because the trustee hasn't distributed the income, then you're actually subject to tax at top marginal rate of 47%. So very important that you have a look at what the trustee has a look at what's happened in the trust, consider the the beneficiaries that are available, and then pass a distribution resolution to document that distribution. Like I said, the ATO have become very, very focused on documentation. So, um, best case scenario is there's a resolution that's considered, documented, signed, and dated, and that is evidence of the income being distributed by the trustee. There are some lesser ways to document that, but ideally you want to have this resolution signed. Unpaid present entitlement, so that's accounting and tax lingo, but essentially an unpaid present entitlement is a distribution from the trust to one of its beneficiaries that has not been settled in by way of cash or an asset transfer. So, give you an example, if my parents' family trust distributes $10,000 to me, and I include that as income in my return and pay tax on it, and that $10,000 has not been paid to me as a distribution, then that is an unpaid present entitlement of mine, and it's a legal right of mine where I can call upon the trustee of that trust and say, hey, can I please have my $10,000? So that is an unpaid present entitlement. A lot of times, trusts will distribute income to companies because companies have access to their corporate tax rates of 30% or even lower, depending on whether you're a base rate entity or not. That unpaid present entitlement from a trust to a company must have some follow-up actions to it. So if you leave it as an unpaid present entitlement, in the old days you could do what is called a sub-trust arrangement, where that unpaid present entitlement can remain as an unpaid present entitlement, assuming you meet certain other conditions, and the company simply charges interest on that unpaid present entitlement back to the trust for a period of up to 7 or 10 years, and then the principal is paid back down to the company to settle that unpaid present entitlement. In the current view of the ATO, they no longer are essentially allowing these sub-trust arrangements to continue. So I've put a link to the TD that talks about that. So if you want to have a read of that after the session, please do so. So sub-trusts essentially are no longer allowed. So you do have to then make a decision with the trustee on what you actually do with that unpaid present entitlement to this company. Do you give the company the money, and then the company then decides what to do with that money from an investment perspective? Or do you put it on a Division 7A loan and service that loan over a 7-year term with minimum repayments required on it every year? So UPS, very, very common thing for us to talk about with our clients. Similar to the comments I made when I was talking about individuals, if you have assets that are in a loss position, you may want to have a think about from an investment perspective whether you crystallize those losses or not. Again, don't let tax drive investment decisions. If you do have something that's under the water but you feel like it will appreciate, then that's something you might want to do as well. Prashant, I'm conscious of time. I think I've only got 5 minutes left. I am happy to stick around for another 10 minutes or so if we want to go through the session. Otherwise, happy to be guided by you on whether we conclude at 1.
Oh, that would be awesome. Thanks so much, Umair.
Okay, look, I'm happy to stick around and follow this through. I do see we've got some more questions. Let me just grab that up. Steve's really liking my comments. Yong, sorry I'm late. Can you please send me the meeting video? So Prashant, I'm assuming you will circulate that.
That's right. Yeah, we will circulate the video.
Okay, great. Okay, so we've covered trusts. Let's talk about companies. So typically speaking, if you have investments and assets over a certain limit, you do derive a reasonable amount of investment income. And in a lot of circumstances, clients tend to set up companies because companies have access to corporate tax rates, which are typically 30% rather than 40%, 47% for individuals. So most of my clients would have typically a family trust, and if there's a need, we may set up a company as well. Similar situation with companies, right? So you want to have a think about income. If there's scope to defer recognizing that income into July, then that would result in that income being subject to tax in FY24 rather than FY23. So there's some timing relief, and then prepayment of expenses as well. So if there's anything that in the company there's scope to claim a deduction, then you may want to think about paying that now as opposed to July onwards. Most of the time, especially with clients that have Sharesight portfolios, we tend to find that companies are used more towards the passive investment side of tax and wealth accumulation rather than more of the active side where you might be running a business out of a company or you might be trading out of a company. So most of my clients that have Sharesight portfolios use companies for passive wealth accumulation rather than active business stuff. So one of the key impacts with having companies from a passive portfolio is around capital gains tax. So individuals and trusts, if trust distributes capital gains to individuals, if that asset was held more than 12 months, that capital gain is eligible for the 50% capital gains tax discount. Companies are not subject to the 50% capital gains tax discount. So you don't get that CGT discount if you have a capital gain in a company. So because of that whole conceptual impact on tax, we typically tend to find that investments tend to be held in trusts rather than companies, but it is a decision that clients make depending on Division 7A loans, as well as how the investment is funded in the first place. So whilst companies don't get the capital gains tax discount, they do pay tax at a maximum rate of 30%. So there is generally value in having a company. And if that company is deriving income, whether it's from trust distributions or whether it's from its own investments, then you do have to have a think about what to do with that value in that company. And declaring dividends sometimes is something that clients tend to do for when there's an opportunity to declare profits out of that company, whether they need the cash or whether they need to meet it for Division 7A loans, or whether there's an opportunity to get it out tax effectively. Timing of the declaration of dividend is important. The declaration happens when the directors of the company need to resolve to declare that dividend. So timing of the payment of the dividend is different to when the declaration of the dividend happens. So the declaration happens when you sign the minute or the resolution. Like I mentioned, if there's value and retained earnings in the company, you do want to have a think about the broader family group to understand what the income levels of the rest of the family is and the shareholders. If you've had a change in circumstances and your income for FY23 is lower than what it might be in the past, declaring a dividend in 23 might be something you may wish to think about, because that dividend income can then be absorbed in your own marginal threshold. And if the dividend is fully franked, because the company has paid tax on that income in the past, the franking credits that you get as part of the dividend can help alleviate the tax on that dividend in personal name. So typically speaking, we do, as part of year-end planning, have a think about the broader family group and the broader individuals and entities in the group to see if there's any scope to declare more of a dividend in this year, to help get profits out, help get cash out, and help fund the lifestyle of the family. So that's something you should look at. And then lastly, and this is more and more common with Sharesight users and clients in that passive space, Division 7A loans tend to be something that need to be managed every year. So just to give you some context on what a Division 7A loan is, if you have a company that has retained earnings and value in it, and that value is supported by cash. So let's say there's a company worth $500,000 with retained earnings, and there's $500,000 of cash to support that profit. If that cash is taken out of the company by the shareholder or by a related party, so it might be husband and wife that takes the money out because they want to go on a big holiday, or they want to fund house renovations, or whatever the case might be, that is deemed to be a loan by the company to the associate of the shareholder. So that falls within Division 7A provisions. And essentially what that means is that loan needs to be serviced as if it was a commercial loan. And essentially you have to put it on a term. So most loans are on a 7-year term, and interest is required to be charged by the company on that loan to the borrower. So on that $500,000 example, the company would need to charge interest to the borrower on that loan. At the moment, that rate is 4.77%, which sounds pretty attractive, but that interest rate that is applied is actually linked to the variable housing loan interest rate. And there is a lag between what the banks are charging on the variable rates compared to what the Division 7A interest rate is. So in FY24 and FY25, I expect to see a big spike in the interest rate that the company is required to charge on these loans, because it's actually benchmarked against a variable housing rate. So I don't know what the right rate is, but I suspect it'll be 6%, 7%, maybe even higher for the next couple of years. So you do need to be careful on borrowing money out of the company. If you do, you might fall within these Division 7A loans where the company has to charge interest on the loan. The borrower has to make a minimum repayment back to the company. And there are calculators available on the ATO website that help you determine what that repayment number is. But more importantly, what you're doing is, if you've used the cash for personal or lifestyle expenses, the house renovation or the big holiday or a fancy car, for example, then what you've done is you've borrowed money from the company and you're paying interest to the company. That interest is subject to tax at the company tax rate. So the company will have to pay 30% tax on that interest. But you may not necessarily be able to claim a tax deduction for the interest you're paying to your own company. So you have to be very, very mindful of taking money out of companies, because you could inadvertently trigger what these Division 7A loan provisions are looking to capture. If you do have a Division 7A loan, you need to make sure the minimum repayment is met by 30 June. So that typically involves finding some money and transferring some cash or assets back down to the company to meet the minimum repayment. If you don't do that, then a lot of the times the company tends to declare a dividend to the shareholder so that the amount that it's owed can be offset by the amount the company owes to the shareholder for the dividend it's just declared. So it's a non-cash way of settling these minimum repayments, but a dividend is taxable income to the shareholder, and the shareholder, if it's a trust, will need to distribute that income to someone, and that dividend will ultimately be subject to tax in an individual name or in another entity. So dividends can help meet minimum repayments, but dividends will also crystallize some taxes, so you just need to be mindful of that. Redraw positions. So I tend to see this where I'm helping accountants out with their clients, where some clients will put money back in on the 25th of June. So let's say there's a $100,000 loan. They will find $100,000, maybe it's out of their home loan offset account, or where if they've got some spare cash, they will find 100 grand and put that back to the company. And then on the 2nd of July, they'll take that 100,000 back out of the company and create a new loan. Now, whilst you've made that minimum repayment, there's actually a specific provision in the Act. It's called 109R, which essentially stops that repayment of 100,000 as being treated as a genuine repayment, because essentially what you're doing is you're taking it in and then you're ripping it back out in the next financial year, and that's actually not allowed. So if you do put it in, you just have to be mindful that you can't take it out again. There are some circumstances where you can take it out, but you have to be mindful about Section 109R of the Tax Act, because that can capture you and stop that 100K from being a genuine repayment. So that's something I see often. It's a sleeper provision. And then it's coming back to interest, right? So like I said on that $500,000 example, the company will have to charge interest on that loan. At the moment, it's 4.77%. It will go up for 24. It will go up again for 25 because it's benchmarked to the cash rate via the home loan variable rate. So then you have to have a more broader strategy discussion on whether you repay that loan back or whether the loan that you borrowed is being used to derive assessable income outside of the company. So coming back to that $500,000 example, if the loan was not for a fancy car, but it was for a share portfolio, for example, so you used that $500,000 and invested in your own name on the ASX 200 index, for example, you've actually borrowed to acquire an income-producing asset, because that share portfolio will throw off investment income and dividend income. So the interest that you're paying to the company is deductible in your name because it's linked to an accessible income. So you have to kind of go back to the core fundamentals of what that borrowing was for, and understand if you can claim a tax deduction for that interest. If you can't, then you have to have a broader strategy discussion to see, well, is it worthwhile just paying back that loan? Should I take a big dividend from the company to extinguish the loan and pay tax on it now because the company is just accruing value and I'm not getting a benefit for it? Or, whether it's worthwhile going to ANZ or CBA and say, hey, I need to pay 6% interest on my loan in the next 2 years, but you're giving it to me for 4%. Can I take some money from you and give it to my company and refinance that loan? So, this can move into financial advice, so you need to be very mindful of what you're up to, but there can be some strategies available whereby these loans, if you've just got them on foot and you're letting them ride for 7 years, you could be in a worse tax position if you tend to do that, if the interest isn't tax deductible. So I do disseminate loan strategies and modeling all the time. It's my bread and butter. This is a very, very common thing with clients. So you just have to be mindful that what you've done isn't ultimately a worse position over the long run because you wanted the money to buy that fancy Ferrari or whatever it was. So interest deductibility is a key component of that. And then lastly, the standard Div 7A term is 7 years under the provisions. If you have real property and the value of that real property is more than 110% of the value of the loan, you can extend that loan from a 7-year term to a 25-year term. And that can be beneficial in some circumstances because the repayments on that loan will become much lower because it's now a 25-year term rather than a 7-year term. There are a couple of key conditions that you need to meet, so make sure you get advice on whether you meet those conditions before looking to put loans on 25 years. And you do need loan agreements and mortgage registration documents, etc., to document that that loan is now secured over real property, and you can get a 25-year term on that. So, given what's happened with the Sydney property market over the last couple of years, clients do have quite a lot of equity in their property. So there are discussions I've had whereby we've managed to extend the loan term to 25 years, and that's helped from a tax and a cash flow perspective as well. So that's something you might want to think about. And I think that's it from the content perspective. There were more questions, so I can have a look to see what the queries are. Nathaniel's asked, when you say family trust and company, does the company hold the assets? Look, companies can hold assets. There's nothing wrong with that, but it's a case-by-case situation to see how the assets are funded. Companies can hold investments, they can hold property, they can hold cash, etc. But like I said, they don't get the capital gains tax discount. So more often than not, family trusts tend to hold the investments, but that is an investment decision for each family member. Because when the family trust disposes of that investment, you can get the 50% capital gains tax discount if that income is distributed to an individual. So that's the attraction of having a family trust, whereby the trust can give capital gains to individuals because you'll get the discount, and then other income, so say dividend income or interest income or trust distribution income, the trustee of that trust can determine to distribute that income to a company. You get 30% tax rate on that, but then you have these unpaid present entitlements, and you might have a Division 7A loan going forward. So it's not super straightforward, and you do need to kind of understand the concepts behind it and have someone who knows what they're talking about, and go from there. So family trusts, companies, they both have their places within a kind of generic family group structure. Justin's asked, shareholders can lend to the company with no interest and no term. So that's correct. So if a company borrows money from a related party, you're not in Division 7A land because it's the other way around. The company has borrowed money, the company has not lent money. So if a shareholder is lending money to the company, you're fine. There's no interest that you need to charge, and there's no fixed rate term that you need to follow under any provisions. Catherine's mentioned that the bench rate of your owner-occupier will be 8.27%. So like I said, it's that Div 7A rate is going to go through the roof in the next couple of years because it follows this variable rate. So I wouldn't be surprised in FY26 companies have to charge 8.27% on their loans to their individual, which basically means that that cost of that $500,000 car that you've financed with borrowing from the company goes up even further because you're paying interest of 8% as opposed to 4.7%. So you certainly want to be mindful about these rate increases and what that means, because you might want to refinance, you might want to liquidate some assets and pay the company down. Over the long run, having these loans can sometimes be a bad impact. So um, that's something to certainly think about. Thanks, Jennifer. Great value. In regards to deferring dividends, how would you go about doing that? Look, if you're talking about investment income and a CBA dividend or an ANZ dividend, there's probably not much you can do because they will pay you when they pay everyone else. So that's taxable upon receipt. But if you've got companies within your own portfolio and they're companies you control, then you have discretion on when the directors of that company declare the dividend. So that can help with deferring the tax on that dividend because it's not declared in June but declared in July. So it does depend on who controls the company that's declaring the dividend. Stephen's asked about trading. 701 trader and one trading account, retail trading, another account. Look, Stephen, I can't give you a direct answer on that because I just don't know what your circumstances are. But and don't quote me on this, but I think you can have accounts under capital and trading, but you probably want to have some specific tax advice on that, and happy to take it offline and give you another insight if you like. That covers all the questions. We don't have time to go through the rest. I'm sorry about that, but I hope this has been useful. My details are on the slides, which we'll share. So, if anybody's looking for some specific tax advice in relation to your own circumstances, by all means, shoot me an email and, we can go from there. But other than that, I think that's it from me.
Thank you so much, Umair. This has been immensely helpful on behalf of all of our customers. I think this has been invaluable. So thank you so much for sharing all your knowledge and insights.
No worries. Glad I could help, and love the Sharesight platform, Prashant. I use it a lot. And if there's any questions from the users, please shoot me an email. We can go from there.
Thank you so much. And thanks everyone for staying well over time. I hope this was really useful and valuable. Thanks so much.